Hey all, Choiboy here. Welcome to another video on my channel Till 7 Figures, where you're on a journey with me to that 7-figure status. Now, we're going to be talking about something a bit different. Not my live stream, not my Sharesies portfolio update. It's like share my opinion on a specific topic that a lot of you might be thinking about, is that what kind of stocks should you be looking into buying during an economic crisis or a bear market, etc. But before we get into it, there is a disclaimer, not a financial advisor. Please do your own research before you buy or sell anything I talk about, because I don't know everything. You just got to cross check it and make sure you're responsible for your own positions in the stock market or in crypto or any other investments. With nothing more to say, let's get straight into it. So what kind of stocks should we be buying in a time like now, where we are unsure of the market? It's at all-time highs. We don't know when the market's going to fall. Is it even going to fall? And if so, how do we protect our portfolios from dipping like 30 to 50% if that happens? There's a couple of things. First of all, what do people do when we get to a bear market? Now, a bear market means that the market is going downwards, meaning the general stock market is losing its price over time. When we go in a bear market, it's normally those big companies at the top of the NZX, for example, Fisher and Paykel Healthcare, Mainfreight. These big companies, like even banks like ANZ, Westpac, it's normally these guys that are losing a lot of its value, mainly because they're already at the all-time high and people are pretty much cashing out just to see where they can put their money in to keep it growing even during a bear market. So what happens from here? Now, that means that if these big companies are losing value, it's normally all these funds, ETFs or mutual funds, etc., all those kind of funds lose value. Now, when those lose value, people who don't really care about the short-term disturbance, they'll keep on that long-term goal and they will dollar cost average it and just buy up more as it goes down. While some people will sell their funds and their big companies and they'll start to put it into two different types of stocks. First, it is dividend stocks. Dividend stocks are one of the most popular stocks people buy during an economic crisis or a bear market. Hands down, it's just really easy to do. What makes dividend companies really good? They have consistent cash flow coming in even during an economic downfall. Good dividend stocks normally give out consistent dividend yield even during an economic crisis where everything is going down. People buy dividend stocks when they think other normal blue chip companies, for example, would not go up in stock price in the near future. So that's where it comes into. Dividends are really interesting. It's really good for people to go into dividend stocks, especially if you have a lot of capital. That's where people benefit from compound interesting from dividends. Now, I'm not going to go into compound interesting too much. You can Google that. Might talk about it in a live stream or another separate video, but do your own research. But basically, there's two main benefits from dividend stocks. Firstly, they give you return regardless of the stock price, right? When a company says it's been consistently giving out 5% per year in dividends, that means that they just do it. Whether the stock price goes up or down, it doesn't matter. They give out the 5%, generally speaking. Two, in New Zealand, you don't pay capital gain tax on stocks that you bought to get dividends from. In New Zealand, you pay tax on any capital gain on a stock, any profit you make from a stock when it goes up in value. Simple. But what is the assumption? It's an assumption that you intended to make a profit when you sell the stock. That is the important part. A lot of people don't get it. But basically speaking, if you buy an investment, a stock, to get dividends from, you only get taxed for the dividend payouts, but you don't pay tax on the capital gain on the stock itself. Where, if you buy a company that does not pay out dividends and you sold it at a $10,000 profit, you need to pay tax on that $10,000 profit based on your income. That's why people tend to go dividend investing as they grow their capital. It's just more worth it, and it's just simple, bit more passive, and it's easier to manage. But some people don't cut it at 5% per year return. If the stock price is also going down on that dividend stock, maybe the dividend is only going to cover the loss of capital. So for that reason, people look into another type of stock in a time like now, in a bear market, in an economic crisis, and it's growth stocks. There's a lot of definitions on what a growth stock is. For me, normally I pointed at companies that has a lot of growth potential and they're still in the small to medium kind of market cap level. Like for example, in the New Zealand market, I say a growth stock would be anything under $1 billion. That would be a growth stock for me, and anything above would be like a bit bigger. In terms of New Zealand at least. In the US, they also call tech companies growth stocks because they just keep growing, whether they like it or not, because they just make a lot of money and they just know how to make money regardless of what the economy does. That's what tech stocks are all about nowadays. Like Amazon, Facebook, all these kind of companies know how to make money whether the economy is going good or bad. For example, I tend to buy more growth stocks. For example, BlackBerry is one of them. Plexure is another one I hold as well. Raycon is a growth stock as well. All these stocks I hold on my Sharesies account, which you can check in any other video below. You will be able to see that I really like my higher risk, higher reward kind of stocks, and which I refer to them as growth stocks. So it's pretty simple. The problem is that the risk that growth stocks come along with is sometimes not really fitted for some people. If you're not patient, if you don't do your research properly, you'll make a lot of mistakes and you'll lose so much money. It happens a lot mainly with growth stocks. You don't really go wrong with dividend stocks. If you buy a dividend stock and keep it for 10 plus years, normally you're pretty sweet. But if you did that on a growth stock where it just doesn't do anything forever, you just missed out on a bunch of opportunity cost, and it's just not worth it sometimes. You just gotta make sure you know what kind of investor you are and what kind of investing style suits you. Not everyone's the same, and not everyone's going to be able to invest the same, and that's why you should not be copying successful investors. You can take on their advice, but take them with a grain of salt. That's the only thing you have to do. Enough with the explaining of what a growth or a dividend stock is. Let's get straight into the sectors you should be looking into. I'm not going to say buy this stock, buy that stock. I don't have a magic crystal ball in front of me that predicts what's going to make me money, right? I'd be a millionaire right now, if so. What I could tell you is point you to a direction where I think it's going to be pretty valuable to look for stocks in for the next couple of years. Sounds good? Let's get straight into it. The first sector you should be looking into, if you're interested in dividend stocks, you should be looking into retail and consumer staples. This is something that people just keep using regardless of if there's an economic crisis or not. You don't stop buying your milk. You don't stop buying clothes just because there's an economic crisis. Sure, there are people that lose their jobs and they have to cut spending, but in general, you don't stop eating, you don't stop buying clothes just because there's an economic crisis. Most people will just feel the fact that prices are getting higher and that's about it. When I say retail and consumer staple, I'm talking about companies like Briscoe's, the Warehouse Group, what else? Kathmandu and Hallensteins. Hallensteins is a pretty famous dividend stock in New Zealand exchange. It's pretty good. They have a pretty good yield of around 5 to 7%, pretty consistent. You can imagine, most teenage boys in New Zealand go through a phase where they buy a lot of their clothes from Hallensteins. I've been through the same kind of phase when I was in high school, and it's no different even 10 years later. So, since that hasn't changed, we don't stop buying clothes because of summer, winter, whatever. We just keep buying clothes whenever we need it. That's why Hallensteins has a really good business. They don't grow as fast, but they have consistent cash flow to give out pretty good dividends. So, these are the kind of things you're looking for in an economic crisis. What business keeps making money? If it's a dividend stock, it needs to keep making money regardless of what the situation is around the world economically. They're very consistent, low profit margin, but they make a pretty decent profit by volume of sales, okay? And those are the kind of things that would make retail and consumer staples a pretty good buy. Another good sector to look into is manufacturing and suppliers, especially tech ones nowadays. There's a lot of hype around 5G technology and so on. There's so many things. If the company supplies for a very big addressable market, that's where they make a lot of money. And that's where Raycon comes in. Something I picked up in June this year. They have a really big play on 5G and the space kind of race we have going on globally at the moment. And these guys make oscillators that goes into pretty much a lot of electronics nowadays, especially in 5G nowadays, where they kicked in to fill up the shortage we have globally around these oscillators. So we got companies like Fisher & Paykel Healthcare, Raycon, and ScalarUp. What else would people use regardless of the economy? Infrastructure and utilities. Public transport doesn't just stop because the economy is bad. Same with utilities such as telecommunications and energy. These two things are something people need on a daily basis. There is no compromise on this. You can't live without broadband nowadays. And fiber is everywhere. Energy is everywhere. Imagine a life without energy. People get pissed off nowadays if they get a power cut for even 30 minutes. That's the kind of life we live nowadays. And these companies normally play a big role on life in general. Some of the companies that might be in this sector would be like Infratil, Spark, Meridian, Vector, Chorus, and Mainfreight. There's a lot more, but I'm just stating out some of the obvious ones, okay? A lot of these companies are dividend stocks because they make good, consistent cash flow, really important, and they can make enough profit to give out as dividends. They're normally quite stable, and they don't really follow the general market trends because it's a stable business. Once you have a decent chunk of the market share of the sector you're in, for example, telecommunications, then you're just going to stay there. For example, energy companies. People don't just change energy companies every year, most of the time. And mobile companies every year or so. People stay on a company they like and they just keep using it. And that's the beauty of these kind of companies. They have a really stable business, and this is what appeals to people who are looking for pretty consistent dividend stocks. So have a look into those companies if you're interested in that. The last sector I would want to talk about is banking. People might be thinking, banking? Really? Like, they're raising mortgage rates? Are they going to make a lot of money? Are they going to lose out on money? There's a lot of things people think about when it comes to banking, but banking and financial services become more of a necessity during an economic crisis. And banks service all these loans and they pretty much give money to people that need it, and with a hefty interest rate, especially with the interest rate going up recently in New Zealand. It's no joke, these guys are making money. Bank stocks are normally quite good dividend stocks as well, so people normally hold a bunch of it. It's normally the older generations that would like to hold bank stocks for a longer time. People like me in their 20s and 30s would not be interested to, hold on to bank stocks because it's boring. Like, bank stock, out of all the stocks you can buy, bank stocks. But there is a pretty good use case for it. It's a pretty good dividend stock. Doesn't pay too well. I would rather go for retail and consumer staples and infrastructure and telecommunications and utilities. Those are the kind of companies I would buy over banking. Banking has a bit more risk compared to these kind of other companies for what I can see. I hope this video made a lot of sense to you and helped you a lot and probably guiding you towards the right direction. If you liked today's video, give it a thumbs up, put a comment down below what you thought. Subscribe to my channel with the bell notifications on for my next live stream and my Sharesies portfolio updates, and I will catch you in the next video. Adios.